Have you ever wondered which is a better investment, Visa or MasterCard? In the world of finance, the two behemoths of payment services, Visa and MasterCard, have always been closely watched by investors. Both with impressive track records, they offer intriguing prospects for those looking to invest. This video aims to provide a comprehensive analysis of their financial performance, comparing key metrics and indicators. Stay tuned as we delve into the financial performance of these two giants. Let's kick things off by looking at the total revenues of both companies. In 2023, Visa's total revenue reached $33 billion, while MasterCard's total revenue was $25 billion. When we compare this to the year 2018, we see that Visa's revenue has grown at a compound annual growth rate, or CAGR, of 10% over the past 5 years. On the other hand, MasterCard's revenue has grown at a CAGR of 11% over the same period. This shows a fairly consistent growth rate for both companies over the years. Now let's break down these revenues. For Visa, 33% of their revenue comes from services, 36% from data processing, 26% from international transactions, and the rest, around 6%, from other sources. On the other hand, MasterCard's revenue is primarily from their payment network, constituting 63%, with the remaining 37% coming from value-added services and solutions. Geographically, Visa generates 43% of its revenue from the United States, and the remaining 57% internationally. MasterCard, on the other hand, earns 33% of its revenue from North America and 67% internationally. But revenues are just one part of the story. Let's also consider profit margins. In 2023, Visa had a net profit margin of 53%, which is slightly higher than its 5-year average of 51%. In contrast, MasterCard had a net profit margin of 45%, which is also slightly above its 5-year average of 44%. This means that, on average, Visa has been more profitable than MasterCard in the past 5 years. In the next section, we'll delve deeper into the net profits of these two financial giants and how they've grown over the years. But for now, remember that while revenues are important, they're just one piece of the puzzle. Net profit is the actual profit after deducting all expenses, including taxes. Now, let's delve into the net profits of Visa and MasterCard. In 2023, Visa's net profit stood at a whopping $17 billion, while MasterCard's net profit was $11 billion. Compared to the year 2018, Visa's net profit has grown at a compound annual growth rate, CAGR, of 11% over the past 5 years. On the other hand, MasterCard's net profit has grown at a slightly higher CAGR of 14% during the same period. This shows that both companies have been increasing their profits consistently, with MasterCard growing at a slightly faster pace. The higher net profit of Visa indicates its superior profitability, while the faster growth rate of MasterCard suggests its potential for catching up. Now that we have a good understanding of their profits, let's look at their assets. A company's assets and liabilities can tell us a lot about its financial stability. Let's take a closer look at the financial standing of our two payment processing giants, Visa and MasterCard, by examining their total and net assets. At the end of 2023, Visa's total assets stood at a whopping $90 billion, more than double that of MasterCard's $42 billion. When we dig deeper and look at net assets, we see a similar trend. Visa has a net asset value of $39 billion, while MasterCard trails behind at $7 billion. Now, if we compare their equity to total assets, an interesting picture is painted. Visa's equity to total assets ratio is 43%. This suggests a relatively balanced financial structure, with almost half of the company's assets being financed by equity. On the other hand, MasterCard's equity to total assets ratio is just 16%. This lower ratio indicates a higher reliance on debt, which can be a red flag for potential investors. However, it's important to remember that these ratios can't be viewed in isolation. They should be analyzed in the context of the company's industry size and growth phase. For instance, a high-growth company may have a low equity to total assets ratio because it's using debt to fuel expansion, which isn't necessarily a bad thing. So what's the takeaway here? Well, on the surface, Visa seems to have a stronger financial position with a larger asset base and a higher equity to total assets ratio. However, MasterCard's lower ratios might be indicative of a more aggressive growth strategy, which could pay off in the long run. Understanding a company's assets is crucial, but so is understanding its liquidity. As we continue our deep dive into the financials of Visa and MasterCard, we'll next explore their liquidity and efficiency. So, stick around, the story gets even more interesting. Liquidity ratios can provide a snapshot of a company's short-term financial health. For Visa and MasterCard, these ratios tell an interesting story. Visa sports a current ratio of 1.45, indicating a strong ability to cover short-term liabilities. MasterCard, on the other hand, has a slightly lower current ratio at 1.17, which still represents a healthy balance of assets to liabilities. Now let's shift gears and look at operational efficiency, specifically focusing on receivable days. This metric provides insight into how quickly a company is able to collect payments owed to them. For Visa, the receivable days stand at a swift 24 days. This means that on average, it takes Visa just over 3 weeks to collect the money it's owed. MasterCard, however, has a significantly higher receivable days at 54. This indicates that it takes MasterCard nearly 2 months to collect the money it's owed. While both companies are efficient, it's clear that Visa has the edge in this area, collecting payments nearly twice as fast as MasterCard. This is not only a testament to Visa's operational efficiency, but also to their strong relationships with customers and vendors. Finally, let's look at how efficiently these companies generate cash. Efficient cash flow generation is critical in ensuring the company's operations run smoothly and that it can meet its financial obligations. Stay tuned for more on this in the next scene. Cash flow is the lifeblood of any business. It's what keeps the gears turning and the lights on. In 2023, Visa's operating cash flow was a robust $21 billion, while MasterCard's clocked in at $12 billion. Both companies are generating strong free cash flow too, with Visa at $20 billion and MasterCard at $12 billion. The ratio of operating cash flow to net income, which indicates the ability to turn profits into cash, stands at 1.2 for Visa and 1.1 for MasterCard. This speaks volumes about their operational efficiency. Now let's look at the DuPont analysis, a method that breaks down return on equity into 3 parts: net profit margin, asset turnover, and leverage. Despite a lower net profit margin, MasterCard's higher asset turnover and leverage result in a whopping return on equity of 161% as compared to Visa's 45%. As we wrap up, remember that investing always involves risks, and it's important to do your own research. Visa and MasterCard are both giants in their industry, but they have their own strengths and weaknesses. Visa, with its higher net profit margin and stronger receivables collection, looks quite robust. On the other hand, MasterCard, displaying impressive growth rates and a massive return on equity, is not to be underestimated. The choice between the two ultimately depends on your investment strategy and risk appetite. Thanks for watching, and don't forget to subscribe to our channel for more insightful videos. Let us know in the comments below which companies you'd like us to analyze next.